Index funds and ETFs are a popular investment option because of their low fees and ability to track the performance of the overall stock market or a specific industry. But with so many options available, it can be overwhelming to know which ones to choose from. By the end of this video, you'll have a better understanding of how to decide which index funds or ETFs to invest in based on your investment goals and risk tolerance. I'm Vineet. Welcome back to my channel, and let's begin. Step 1. Determine your investment goals. To determine your investment goals, ask yourself questions such as: what is the purpose of your investment? Are you saving for retirement, a down payment on a house, or funding your children's education? What is your time horizon? Do you plan to invest for the long term meaning 10 years plus, or for the short term, 1 to 5 years? What is your risk tolerance? Are you comfortable with fluctuations in the market, or do you prefer more stable and conservative investments? If you're investing for long-term growth, you might consider index funds or ETFs that track the overall stock market, such as the S&P 500 or the total stock market index. These funds offer exposure to a broad range of companies and have historically provided consistent growth over time. If you're investing for short-term gains, you might consider index funds or ETFs that track a specific industry sector, such as the technology or healthcare sector. These funds can provide higher returns in a shorter amount of time, but they also come with higher risk. Let's consider an example. Suppose you are in your late 20s and you have a long-term investment horizon. Your primary goal is to save for retirement, and you are comfortable with taking on some level of risk. In this case, you may want to focus on index funds like VTSAX that provide exposure to the overall stock market for long-term growth. Step 2. Understand the fund's objectives. Each index fund or ETF has a specific objective that determines the asset it tracks. For example, an S&P 500 index fund. This fund aims to replicate the performance of the S&P 500 index, which represents the 500 largest publicly traded companies in the United States. It offers broad exposure to the US stock market. On number 2, the technology sector ETF. This ETF focuses on tracking the performance of the tech sector and tech companies such as Apple, Microsoft, and Amazon. It provides concentrated exposure to the technology sector. Understanding the objective of a fund helps you align it with your own investment goals. If you want to invest in the overall stock market, an S&P 500 index fund would be suitable. If you believe in the growth of a potential of a specific sector, you might consider of investing in a specific sector-focused ETF. Step 3. Analyze the fund's holdings. Analyzing the holdings of an index fund or ETF is a crucial step in understanding its composition and suitability for your investment goals. Here are some factors to consider when evaluating the fund's holdings. Number 1. Diversification. Assess the level of diversification within the fund. Diversification helps spread risk by investing in a variety of assets. Look for funds that hold a broad range of stocks across different industries, markets, capitalizations, and geographic regions. For example, a total stock market index fund aims to replicate the performance of the entire stock market by including a diverse range of stocks from various sectors and market segments. An international index fund may hold stocks from different countries, providing exposure to global markets and diversifying your portfolio beyond domestic investments. Diversification can help mitigate the impact of a single company or sector's performance on your investment funds. Number 2. Sector allocation. Evaluate the fund's sector allocation to determine if it aligns with your investment objectives. Different sectors perform differently at various stages of the economic cycle. If you have a specific sector outlook or want to capitalize on a particular industry's growth potential, consider funds that are overweight or specialized in the sector. For instance, a tech sector ETF will focus primarily on tech-related companies such as Apple, Microsoft, and Intel. This fund is suitable for investors who believe the tech sector will outperform the broader market. A healthcare sector index fund might invest in pharmaceutical, biotech, and healthcare services companies. This fund can be appealing if you have a positive outlook on the healthcare industry. Analyzing sector allocation allows you to align your investments with your expectations and beliefs about specific industries. Number 3. Top holdings. Review the fund's top holdings to understand which companies have the most significant impact on its performance. This information can provide insights into the fund's concentration and potential risks. Look for transparency in the fund's disclosure of holdings. If a fund has a high concentration of a few stocks, it may be more susceptible to performance of those particular companies. This concentration can amplify returns but also increase the risk if any of those stocks experiences significant volatility. Conversely, if a fund has well-diversified portfolio with a large number of holdings, it may reduce the impact of any single stock's performance on the overall fund returns. Consider whether the fund's top holdings align with your own investment preferences and risk tolerance. Number 4. Performance attribution. Some funds provide performance attribution information that breaks down the fund's returns by factors such as sector allocation, stock selection, and country exposure. This analysis can help you understand how different factors contribute to the fund's performance. For example, if a fund's performance attribution shows that a significant portion of its returns comes from a successful stock selection within a specific sector, it indicates the fund manager's skill in picking winning stocks within that sector. Step 4. Evaluate the fund's performance. When evaluating the performance of index funds or ETFs, it is essential to consider several factors to gain a comprehensive understanding. Here are some key aspects to assess. Historical returns. Look at the fund's historical returns over different periods of time, such as 1 year, 3 years, 5 years, and since inception. Compare these returns with the fund's benchmark index and other similar funds in the category. For example, if you are considering an S&P 500 index fund, compare its returns to the performance of the S&P 500 index itself. The closer the fund's returns are to the index, the better it has replicated the benchmark. Analyzing historical returns helps you gauge the fund's ability to track the index and achieve the desired investment outcomes. Number 2. Consistency of performance. Assess the fund's consistency in delivering returns. Look for steady and consistent performance rather than focusing solely on short-term spikes or outliers. Analyze the fund's performance across different market cycles, including both bullish and bearish periods. A fund that has performed well consistently across different market conditions is often seen as more reliable. Consistency is more important because it indicates the fund's ability to navigate different market environments and deliver stable long-term growth. Number 3. Performance in various market conditions. Analyze how the fund has performed during different market conditions, such as bull markets, bear markets, or periods of heightened volatility. Consider how the fund has fared during market downturns or recessions. Did it experience significant drawdowns, or did it exhibit resilience and performance relatively well compared to its peers? Understanding the fund's behavior during different market environments can provide insights into its ability to weather storms and protect your investment during challenging times. Number 4. Fund manager's track record. If the index fund or ETF is actively managed, evaluate the track record of the fund manager. Look at the fund manager's experience, expertise, and their ability to generate consistent returns. Consider factors such as manager's tenure, investment philosophy, and any relevant accolades or recognitions they have received. A strong and experienced fund manager can play a crucial role in delivering superior performance. Past performance is not a guarantee of future results. However, analyzing historical performance and other relevant metrics can help you make informed decisions when selecting index funds or ETFs. Additionally, consider the fund's performance relative to your investment goals, risk tolerance, and time horizon. Step 5. Consider the fund's fees. Fees can significantly impact your investment returns over time. When comparing funds, consider the expense ratio, the annual fee charged by the fund. Lower expense ratios are generally more favorable. For example, Fund A has an expense ratio of 0.1%, while Fund B has an expense ratio of 0.5%. Over the long term, the lower cost Fund A may provide higher returns due to lower fees. Additionally, be aware of any transaction fees or commissions charged by a broker. Step 6. Review the fund's risk profile. Understanding the risk profile of a fund is crucial in making investment decisions. Consider the following factors. Number 1. Volatility. Look at the historical volatility of the fund. Higher volatility indicates a greater likelihood of price fluctuations. If you have low tolerance for risk, you may prefer funds with lower volatility. Number 2, beta. Beta measures the fund's sensitivity to market movements. A beta of 1 indicates that the fund tends to move in line with the market, while a beta greater than 1 suggests higher volatility than the market. If you prefer a more stable investment, you may opt for funds with lower beta values. For example, if you have a conservative risk tolerance, you might prefer a low volatility index fund that tracks a broad market index. On the other hand, if you are comfortable with higher risk, you may choose a high beta that focuses on emerging markets for potentially higher returns. Investing in index funds or ETFs can be an excellent way to build a diversified portfolio and achieve your financial goals over the long term. But it's essential to regularly review your investments and adjust them as needed based on changes in your investment goals, risk tolerance, or market conditions. I hope you liked this video and found it helpful. Please subscribe for more helpful personal finance content and click on that like button to get this video recommended to other people. Please share your thoughts in the comments below as well. Thanks for watching, and I'll see you in the next one.